Imagine a young Warren Buffett, not yet the Oracle of Omaha we know today. He wasn't your average kid. While others played baseball, Buffett was busy building a business empire, selling chewing gum, Coca-Cola bottles, and even used golf balls door to door. This entrepreneurial spirit fueled his obsession with numbers, leading him to devour stock market reports instead of comic books. At 11 years old, he buys his first stock, a taste of the financial world that will soon consume him. But life throws him a curveball. Harvard Business School, the pinnacle of academic prestige, rejects his application. A crushing blow for most, but for Buffett, it's a turning point. It leads him to Columbia University, where he meets Benjamin Graham, the father of value investing. This unlikely pairing ignites a spark, setting Buffett on a path to acquire a failing textile company named Berkshire Hathaway. It's a move that baffles Wall Street, a risky gamble on a dying industry. But Buffett sees something others don't, a hidden potential that could transform this crumbling business into an empire. How did Buffett manage to turn a crumbling textile company into one of the world's most diversified and successful conglomerates? These are not just stories, they are your blueprints for success. This is Turnaround Source. Berkshire Hathaway wasn't always the powerhouse it is today. It started as a humble textile manufacturer in New England, a legacy dating back to the 1800s. But by the 1960s, the industry was in a freefall. Foreign competition, rising labor costs, and changing consumer preferences had left the company reeling. Seabury Stanton, the CEO, was struggling to keep the company afloat, but the tide seemed to be against him. The mills were outdated, morale was low, and profits were dwindling. It was a classic tale of a once proud industry on the verge of collapse. In the business world, the rearview mirror is always clearer than the windshield, Buffett would later say. But even with hindsight, the future of Berkshire Hathaway looked bleak. So why would a young, ambitious investor like Warren Buffett be interested in this sinking ship? Buffett, fresh from his Columbia education and deeply influenced by Benjamin Graham's principles of value investing, saw something in Berkshire that others missed. Graham's core idea was to buy undervalued companies whose stock prices were lower than their intrinsic value. Buffett recognized that Berkshire's underlying assets were worth significantly more than its plummeting stock price, presenting a classic value investing opportunity. He started buying up shares, accumulating a significant stake in the company over time. But when Stanton tried to outmaneuver him with a deceptive tender offer, Buffett's pride kicked in. Price is what you pay. Value is what you get, he often said. And in this case, he felt the value was being manipulated. In a bold move, Buffett staged a boardroom coup, ousting Stanton and installing a new management team. It was a hostile takeover, a gamble that could have easily backfired. But Buffett, with his unwavering confidence and sharp business acumen, was determined to prove his doubters wrong. He had a vision for Berkshire Hathaway, a vision that extended far beyond textiles. It was a vision that would revolutionize the very concept of investing. Buffett's vision was to transform Berkshire Hathaway into a diversified holding company, a collection of profitable businesses operating under one roof. But to do that, he needed cash, and lots of it. That's where insurance came in. In 1967, Berkshire acquired National Indemnity Company, a small but profitable insurer. This was a pivotal moment. Insurance premiums provided a steady stream of cash, what Buffett called float, that he could use to invest in other businesses. To put this into perspective, Buffett's initial investment in Berkshire Hathaway was around $1 million in the mid-60s. Today, the company is worth hundreds of billions of dollars. This was the genius of Buffett's strategy. He wasn't just buying companies, he was creating a self-sustaining engine for growth, a financial ecosystem where one business fueled the next. Over the next few decades, Berkshire Hathaway's portfolio grew exponentially. Buffett acquired iconic brands like Geico, See's Candies, and a massive stake in Coca-Cola. He invested in railroads, energy companies, and even a major stake in Apple. "Our favorite holding period is forever," Buffett famously said, and he meant it. He held onto these investments for the long haul, weathering market downturns and reaping the rewards of compounding returns. But it wasn't always smooth sailing. Buffett made his share of mistakes along the way, like his investment in Dexter Shoe, a company that ultimately failed. But he never let these setbacks deter him. "Only when the tide goes out do you discover who's been swimming naked," he quipped. He saw these mistakes as learning opportunities, refining his investment principles with each misstep. So, what can we learn from Buffett's incredible journey with Berkshire Hathaway? Don't chase fads. Look for undervalued companies with strong long-term potential. Resist the urge to make quick profits. Invest for the long haul. Invest in companies with ethical, competent leaders who think like owners. Don't put all your eggs in one basket. Spread your investments across different industries. Look for businesses that generate consistent cash flow, which can be reinvested for growth. These principles, applied consistently over decades, turned Berkshire Hathaway from a failing textile mill into a financial titan. The story of Berkshire Hathaway is a testament to the power of vision, resilience, and the ability to adapt to change. It's a reminder that even the most unlikely businesses can be turned around with the right strategy and leadership. Remember, as Buffett himself said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Ever wondered how some companies turn challenges into unstoppable growth engines? The secret is the flywheel effect, a powerful concept coined by Jim Collins that perfectly describes Berkshire Hathaway's extraordinary rise under Warren Buffett. In our next video, we'll explore how this principle can transform your business into a success story. If you haven't already, subscribe now so you don't miss out on unlocking the secrets to exponential growth. Your business turnaround could be just a few smart decisions away. Join our mailing list for exclusive access to insider tips and strategies, your blueprints for success. Let us know in the comments what turnaround stories or topics you'd like to see next.